Lenders 20 questions on pass-throughs and K1s, video 11. Why should it matter whether the return is cash basis or accrual basis, and how do I tell? Well, first of all, I know this sounds like accounting and you're thinking, do I really need to know this much accounting to do tax return analysis? Well, the answer is yes. First, I'll give you the definition between the two, and then I'll help you understand where you'll find the information, and finally, what difference does it make? Cash basis is where we recognize income when we actually receive it. We recognize expenses when we actually cut the check. So it's pretty much a checkbook with some depreciation thrown in, and you've got cash basis statements. Accrual basis is where we recognize income when we earn it. If I haven't earned it yet, and if you had my balance sheet, you'd see accounts receivable in the assets. And I recognize expenses when I incur them. Haven't paid it yet, you have my balance sheet, you'll see accounts payable in the liabilities. Well, you determine whether it's cash basis or accrual basis on these pass-throughs on a 1065 on page 1 right below the address. On the 1120S, it's in that Schedule B Other Information page. So here's why it matters. You're going to compare 2 or maybe 3 years tax returns. You're going to draw conclusions about whether this business is doing better, doing worse, or maybe stable. If my tax returns are on cash basis, it can look like business is up when all that happened is someone who didn't pay me last year finally paid me this year. In fact, it can look like business is up even if the actual revenue I've generated that year is down. So cash basis doesn't give us an accurate portrayal when we are comparing 2 or 3 years tax returns. I'm not saying don't compare them, just understand that if it's on cash basis, the difference may not be based on activity level. The other difference is this. If your borrower says, you know, here's my tax returns, but it really doesn't reflect what happened this year, well, they could be telling you that they cheat on their taxes, but really they might just be saying that they really did make more revenue this year, they just didn't get it all yet, so the cash basis doesn't reflect it. So notice first, before you start comparing numbers, which you have, cash or accrual basis. And if it's cash basis, be cautious comparing the years. If you enjoyed this information and you would like to receive all 20 free videos of the top questions lenders ask and should ask about business, personal, and global cash flow from pass-through entities, along with a copy of my tax return analysis quick reference guide, visit the URL on your screen.